Hello, and welcome back to another episode of Accounting 2301, bringing you straight to the record chart of Chapter 7, dealing with accounts receivable. So, in this chapter, we're going to learn a lot dealing with accounts receivable and notes receivable and ways where what happens in the scenario if no one pays us that we send a bill to. How do we handle that? So, the first part that we're going to get down to is the types of receivables we are going to look at. One is the classic accounts receivable, and these are normally going to be for short periods of time, usually around 30 to 60 days. After it gets past 60 days or 90 days, we want to kind of watch out because we're probably not going to get the money back. But we're just going to see what happens when that does happen. Now, we also have notes receivable. These notes receivable are actually written agreements of credit. Okay? So this is going to be similar to what we've done in Chapter 4 when we're dealing with the buyer and seller. Except this is with more on the basis where we don't owe someone, they owe us. Okay? Now, there is two types when we deal with receivables. Okay? Especially with accounts receivable. We have one that is known as the allowance method. And this one is actually used by a lot of big business. Here, they take basically what the revenues are and expenses, and they estimate how much of AR is going to be uncollectible. Now, the key thing is estimating, okay? And you're going to hear me say that probably quite a bit when we deal with the allowance method. The other method that you got is the direct write-off. And this one is probably the easiest of the two methods. So, of course, we're going to have a little bit of it, but this is mostly used for small businesses. Ones that have very little receivables, if any. So, some of the examples are the restaurants and the small retail stores, even the hardware stores, etc. It has to be usually the mom and pop stores. They're not expected to have one. And we only do the direct write-off method when we know it's going to be uncollectible, it's worthless. We couldn't even send Greedo out there to break legs. We just want getting money. So, with that, we do have the graphic right here that shows you the difference between the two. Again, we're going to get into a new account called bad debt. And bad debt is basically when we know that a receivable is going to be basically uncollectible. We're not going to get the money. With direct write-off, we record bad debt when we know that specific customer account is no longer going to pay us. Okay? It is deemed uncollectible. With the allowance method, we estimate it based on either 1, percentage of sales, or 2, an analysis of receivables. So we're going to get into both of those methods. Okay? And then allowance account, primary users, there is no allowance count in direct write-off. And it's really, again, small companies. Here we have an allowance count, and that large companies basically use this. So, what is the allowance method? Why do we have it? Well, again, big businesses, they have a lot and tons of customers. And sometimes some customers do well, some customers do bad. Some are going to only pay a certain percentage. So, with us, we actually have to recognize, we still have to match our revenues and expenses. Well, the IRS lets us actually estimate a little bit of what we're not going to receive. So with this, estimate, we get to create an account known as Allowance for Doubtful Accounts. And the best way to kind of picture this is basically as a bucket. Allowance for Doubtful Accounts is a balance sheet account, and we basically, once we made the estimate, we fill our bucket. And we don't empty that bucket until we actually write off the accounts. So we keep pouring money in there, and eventually it overfills and we have to pour some out. So it does end up kind of being known as the bucket method a lot of times with the allowance method. And the best thing, giving you a preview already, but the best thing with this is to actually show you an example form. So assume a business has 105,000 of accounts receivable. At the end of the year, and based on analysis, so this one's based on analysis. Remember, there's two types. There's one, the percentage of sales, and one, analysis. So based on analysis, right here, so that's a key thing, 4,000 is likely to not be collected. The business would set up an allowance for the amount deemed to be uncollectible. So we don't know the specifics. We just know by analysis, which is usually history, because we do look at history when we look at analysis, and this is just a deem. So since we don't have a specific customer, this is where it also counts as an estimate. So we're going to set up a new account called Allowance for Doubtful Accounts, or basically the ADA. Now watch out. Remember back in chapter 3 I said I'm going to introduce more contras later on. This is another contra asset account. Very like accumulated depreciation. Okay? So since it's contra asset, that means even though that this is an asset account, its normal balance, that which side it increases on, is a credit. So when we find out that 4,000 is the amount that we're going to deem uncollectible, we actually get to put in this journal entry. We're going to set up our bad debt expense. So we're going to go ahead and have our expense there. So this is our expense matching our revenue, basically. Out of this 4,000, we make sure we make a credit to allowance for doubtful accounts. Now, this is saying to the IRS or SEC or any investor that we do suspect that 4,000 of our 105,000 will not be collected. We will not get that money, but we still earned the money from, or the revenue from, any job that we have done. But right now, we're just assuming that. Will it happen? Will it not? We don't know. Okay? So, when we have this going on, with our depreciation, remember back in chapter 3, we did a little bit about book value. Well, chapter 8 is going to have that again. Here we have net realizable value. And this is basically the net amount that we expect to collect from AR. So with that, using our example, we're going to basically know that we're going to collect $101,000. That's basically what our AR is going to be. And so when we look at net realizable value, all we do is take what's in accounts receivable and minus what's in allowance for doubtful accounts. So this is what is known as net realizable value. So this on a balance sheet will pretty much look like accounts receivable minus allowance equals to 101,000. So investors know how much we basically expect to collect from AR. So under an allowance method, what would happen if we actually finally know a specific customer is not going to pay? Okay, so we're going to take John Parker. He has not paid his receivable of $610 in over a year. Well, if it's been over a year, yeah, I would probably kind of assume that he ain't paying us. I mean, we should have probably wrote him off a while ago, but I guess management was just waiting and waiting, and it just didn't happen. So when they're not going to pay, you're going to notice this. This is when we debit allowance for doubtful accounts. Okay? Again, we're under the allowance method. Allowance for doubtful accounts only appears in the allowance method. Okay? So, we're going to credit the accounts receivable. Notice that it's now specific to that customer. All customers and accounts receivable all have their individual ledgers. Okay? So you remember ledgers back from chapter 2? All of them have their own specific ones. So we actually get to write them off to their specific accounts. With doing so, we just said that John Parker now does not owe us any more money due to the fact we have recognized that he will not pay us. He is uncollectible. Boom. We may sell this off later for a collections agency. Whoever wants it, we may do that, but we're going to take the expense right now. But if you look at it, it goes straight from an asset to an asset. We've already set up allowance. Allowance got set up right up here. Okay? So we no longer use bad debt expense. Everything else flows through allowance for doubtful accounts. So we wrote off John Parker. Then all of a sudden, out of the blue, he pays us because he won the lottery. Yay for him. Maybe it was that like 625 million that was done like last year or something, or however much that was. So he won the lottery and he decides to actually pay us that lowly $610. So when a customer pays us after we wrote them off, we're going to have two accounts. Okay, two journal entries. With this, the first journal entry is going to have to be reinstating his account. So when we restate, let me see if I have anything else. There we go. So when we restate right there, missed the A. Alright, so when we restate, it's basically going to be a reversal of the write-off. Okay, so we take accounts receivable to his name, John Parker, and we're going to debit 610 because now we say he now owes us 610 again. Since that was from allowance for doubtful accounts, that one gets credited. So it's always like a reversal of the write-off. So second entry that we have to do is the classic one of him paying us. And we've done this entry in a few chapters before. But here it is again. So we received the cash. So we got 610 bucks finally back after over a year. And then we just credit his account and say that he no longer owes us this money due to that he actually paid it. Okay? So we finally got our cash. Everything's happy, everything's right in the world. Okay? So how did the company decide that $4,000 was likely not to be collected? So again, this ranges on two methods. They actually use the analyze method, which was how they do it. Now, if you use the analyze method, that's mostly right here. But first, let me show you just how percentage of sales work. Okay? Since that's the first one up here, we like that. Let's do percentage of sales. Now, this is where the bucket method actually comes in more. Because again, this one just adds to allowance account. When we actually know an analysis, it doesn't really add because we know specifically how much to estimate due to history. Okay, so let's do with the percentage based on sales. Okay, so we know a company has experienced past experience. About 1% of credit sales on account are always uncollectible. Okay, if the company has 300,000 in credit sales, we would simply assume 3,000 would be uncollectible and add that amount to the allowance account. So with that reading right there, all we did was take this 1% and times it by 300,000. This is where we got 3 grand. So when we do this journal entry, we're going to automatically always do bad debt expense 3,000 and allowance for doubtful accounts of 3,000. So again, based on past experience, percentage right there. So 1%, not too bad. But again, we don't change anything here. On the other hand, if we estimate allowance based on receivables themselves, we're going to notice this, that usually history states that if it reaches to a certain point of past due, it is extremely less likely that we're going to collect on those receivables. So using that history, we can kind of guess, pretty much estimate the percent uncollectible. So notice this chart. This is actually something you can actually find, especially in software, but this is our general ledger, basically account known as age of receivables, where somebody actually goes and looks at all these balances and sees which one or how long have they owe us money. Okay, usually QuickBooks, if you do that software, it has one place where you can go to where it has it, and it's awesome. Here we see this customer or a client. They're going to notice that if it's not past due, history states about 2% is not going to collect. Okay, now we have told all of our accounts. Notice the wavy lines just means that there is a break, so they don't show everything. But our total was 125,000. Percent uncollected was about 2%, so it's about 2,500. In 1 to 30 days, we estimate about 5% will be uncollected. 31 to 60, 10%. 61 to 90, 20%, and so forth and so on. So again, as they get older, it's very hard for us to actually collect the money. We're most likely not going to see it. So when we finally do all of our percentages, we're going to add them all together, and this is going to be our estimated uncollected due to the analysis of the receivables. When we have this is more of a specific amount that we know that's uncollected, because these things are going to get older and they're going to change their amounts. Because we know the specific, we need to do an adjustment. So with that adjustment, we need to make ADA, or our allowance for doubtful accounts, the same as this number. So this is more of an adjusting entry. Okay, so with this being said, we know we gotta make it to 26,490. We're gonna assume that right now it has about 10 grand in there right before this analysis. Because it has 10 grand and we need to get it to 26,490. Again, this is where T accounts will show. So I would just go ahead and watch the homework video when it comes out, and I will probably do a T account most likely to show this method. So T account for allowance doubtful accounts is going to be something good, because again we have a beginning balance of 10,000. We want to make it to 26,490. So all we got to do is basically make a subtraction. So right now allowance is going to increase by 16,490 because it's got to get up to this 26,490. Okay. Now we would make our journal entry for, again, bad debt expense and allowance for doubtful accounts. Again, when we're adjusting allowance for doubtful accounts, increasing or decreasing when we set it up, this is basically what we're doing. We did the analysis, we found out how much we're expected to be uncollectible, so we're setting up allowance for doubtful accounts. Even if it's an adjustment, it's setting it up for that current month. It's always to bad debt expense on the setup. Then again, everything flows through allowance for doubtful accounts. Now, as you can see here on this note, if it was the other way around, because allowance for doubtful accounts every now and then may have a debit balance, it has a debit balance of 10 grand. Then we need to add the two, because it's a debit balance. We know it's supposed to be a credit of 26,490. So with that, the adjusted entry is 36,490. Here, notice that we had a credit balance. So that one's a little bit tricky to understand. Again, T accounts do help. So I would definitely do a T account. Know that when we estimate these, again, that's a credit balance. Okay. So the percent of receivables method is just pretty much really a lot like the percentage of sales. So this one we actually look at how much is in accounts receivable, and we just basically make a percentage again. So with the percentage of receivables method, it's more of an adjustment than adding. Okay, when it's percentage of sales, again we add. We don't do anything else. We just basically figure out the percentage times these two, and that's it. We just make our journal entry with the amount. Here, because it's dealing with receivables, must adjust. This one again, dealing with receivables, so we must adjust. So you're going to see this one probably on the homework also, or maybe on the exam. So with this, we have Musicland. Hopefully that's an amusement park, because that'd be cool. Anyway, has about 50,000 in accounts receivable and a $200 credit balance in allowance for doubtful accounts on December 31st, 2017. Our past experience again suggests about 5% of total receivables are going to be uncollectible. So again, we do the little thing that we do in percentage of sales. Take the 50,000 times the percentage, shows us about 2,500. So in our allowance for doubtful accounts, here's a good example of the T-chart. We have our balance at the beginning, then we had a lot of write-offs, but we have basically a balance of about 200. With this, we want to make it to 2,500 because that's the amount we deemed based on receivables not sales, but receivables that we will have uncollected. With that, to get from 200 to 2,500, we need to make an adjustment of 2,300. Again, it's increasing to 2,500. So with that, that's again setting up our allowance for doubtful accounts with the new amount. So our adjustment entry again is bad debt expense, debit, and the credit for allowance for doubtful accounts. Okay. So nice little graphic here. When we look at bad debt estimation, so we got, if we're looking income statement focus, again, emphasis on matching, we're going to take percentage of sales. And sales times whatever rate and whatever percentage we deem will equal bad debt expense. Again, this is the exact amount. We do not really make an adjustment. Okay, it's just bad debt expense and ADA. Okay, here on the balance side. So on the balance side, we got the two. We have percentage of receivables and age of receivables. Both of these will adjust the allowance for doubtful accounts. Percentage of receivables a little bit easier. Take accounts receivable times the rate. Here we take basically a total after we times all the receivables by their age, by their rates, and we'll get them. Again, this one's more of an adjusting entry to allowance for doubtful accounts to set up bad debt expense. This one's just a straightforward to it. Okay, so this side will add to ADA. This side gives us a specific amount for ADA that we have to get to. Okay, so that brings us to the direct write-off method. Again, that's allowance method is the one that you're probably going to see more often, especially with big business. Direct write-off, again, it's going to small businesses because we're easily able to determine who did not basically get us the money. So when we do this, this is going to be similar to these journal entries right here, except you're going to notice that because the direct write-off does not have allowance, does not have an estimate, we're going to do it very quickly. We're going to write it straight to bad debt expense. So bad debt expense of the 420 from DL Ross, and we have accounts receivable of DL Ross of 420. Okay, so this one again is more easy. We only recognize bad debt expense when it actually becomes worthless. There's no estimate. So again, if he decides to pay it off, so DL Ross decides to pay it off, maybe he actually got together with Kohl's and got some money from them and decides to pay it off. Again, we're going to have those same two journal entries. So the first journal entry again is a reversal of the write-off. So accounts receivable, DL Ross, he now owes us the money again. We can no longer recognize the expense under direct write-off. So bad debt expense gets basically credit for the 420. And then the second one, after he reinstated his account, we get market paid by saying we received the cash. And accounts receivable, DL Ross, gets credited, so he no longer owes us. So this is where we deem it uncollectible, or basically write it off. He's not going to pay us. Here, he decides to pay us, so we have to reverse it, or basically reverse the entry, and then do the cash. Okay, that's it. Direct write-off is so much easier. There's nothing to estimate. But again, example here, under the allowance method, we only charge bad debt expense once. It's only when we set up the allowance. After that, everything runs through the allowance account. Under direct write-off, bad debt expense is the one that gets charged every time accounts is uncollectible. There is no allowance. Okay, so watch out on the methods. Allowance method, you should automatically know, has allowance for doubtful accounts, allowance. If it's direct write-off, it's directly to bad debt expense. So let's look at the second part of this chapter. Second part, the other receivable that we want to focus on is note receivables. Okay, so when we get a note receivable, we're probably going to have a promissory note. And this graphic really gets you everything that should be on one, or one that you actually will see. And of course, we're going to have the principal. We're going to have it basically probably as a number and as writing. Writing always trumps out the numbers. Okay, that's the same thing on checks. We'll have whenever the date of the note happened, we're going to have the due date. So again, 90 days. And whoever the payee is, this is Techcom company, we're going to have the interest rate. Now watch out on interest rates. Since note receivables can be short-term and long-term, notice this is a short-term one of 90 days. This percentage interest rate is biannual. It's an annual rate. So watch out. We're probably going to have to convert that to months. And of course, we'll get whoever the maker is. So whoever actually made the note. So Julia Brown made a note that says Tomcom company will pay $1,000 in 90 days with an interest of 12% annual, but it's really less than that. Okay, so with notes, you're going to have interest. This is going to be fun. Interest, yay! We get to calculate a little bit interest. So this is almost getting into finances in a lot of ways with time value money. But we're not going to really get into time value money. We're just going to do it basically on the simple amount right here. So the basic formula to calculate interest is the face amount, principal, times the rate times time in years equals interest. Now, if we do this, we're going to take 1,000 and we want to times it by its rate of 12%, so by 0.12, and then times it by time. Now, time really is by years, so 90 divided by 360. Again, we're not going to take 365. It throws things off. Most likely, mostly we always use 360. That's how we determine. So 90 divided by 360 eventually equals to $30. Now, if it's somehow 12%, and you know you're doing monthly, you can also do it another way. You can probably divide 12% by months. So 12 divided by 0.12, or basically you're going to get into like one month. So 0.12 divided by 12 will be 0.01 ish, and times that by 1,000, so 1%. You times that by 1%, then times it, by 3 months, will get you the same thing. I would normally just say use this, because we're going to work in days mostly. It's going to be a little bit easier, but some people prefer the other way. So, with this, we can assume a few little things. One, the full amount is going to be paid at the end of 90 days. That's the note. If they don't pay, then we got probably go through some legal items and stuff like that. We may have some late fees. Fun stuff. So when it's paid, we're going to have 3 accounts. One is going to be the cash account. Cash account is going to be the total principal. Here, I don't know why it's 2. It should be 1. So fix that. So here we have 1,030 bucks. So 1,000 plus 30 is how much cash we received. We received the principal plus the interest. Here, they no longer owe us the note receivable. So their account is done. 1,000 is done. Okay? But with the interest, we've actually earned this interest by providing the note. So with this, we have to recognize the revenue. So we need to put interest revenue of $30. That's when everything is paid in full, no problems. But sometimes that does not always happen in 1 year. We may actually have it spread out. I know, you're like going, oh my god, I thought it was just going to be that easy. No. Do the gap again. We have accrueds because we've earned that interest in the year. So we must record that revenue in the year that it actually has been earned. And of course, not all notes in 1 year. Some of them may spread past December 31st. So with this example, now we have a note that overlaps December 31st basically. And again, we're going to assume now that the principal is 4,000, the time is 90 days, and the rate is 12%. Okay? This happened on December 1st that we did this note. So December 1st to December 31st, that's only 1 month. So we have to accrue 1 month of interest. So our journal entry is going to be interest receivable of 40 and interest revenue of 40. Okay, so we expect to receive this interest. So again, another new account. So again, we're expected to receive this. Now, again, how we get the 40 is taking the 4,000 and multiply it by 0.12. And then multiply it by 90 divided by 360. And when you actually do this, it's going to come out to a total interest of about 120. Okay? If we know this is 3 months, divide that by 3. And you'll get 40 per month. We have 1 month, so it's $40. Another way you can do this is taking the 4,000 times 12. So the 4,000 times 0.12 times probably 30 days divided by 360. And that will end up equaling out to the 40. Okay? So you can also do it that way. Depends on which way you would actually like to do. I mean, that one's a little bit simple. I would probably run with the second one just because we already know the days. Now, again, either way will be actually fine as you go through, but do not forget to take 360. Do not go 365. And notice I did not go 31 either. If I go 31, then we get all these percentages, and it's really not what's going on. We're going to just basically take it as 1 month at 30 days. Simple as that. Okay? So when we receive the money next year, we're going to receive the money. Again, here's our calculations going on right here. So, here, again, I would always strongly encourage do the credit accounts first. Okay? first off, note receivable is always going to be the principal. So our principal was $4,000. So they paid us our $4 grand. Next is going to be interest receivable when we deal with accrued. So interest receivable was 40. They paid us the 40. And last is interest revenue. So again, you can use the formula right here, the second one. And if you do that, it will come out to 80. If you did it this way, you know that we only did 1 month at 40. 2 more months will be 80 to get us to 120. And basically, if you do this one first, all you have to do is add them all together, and that will get you our cash. Or you can do cash basically like this. Take the 4,000, the principal, and then plus our formula to find the total interest. We don't receive that cash until due date, usually. So you must have to basically credit the receivable of both note receivable and interest receivable, and now credit the revenue. We earn that 80 in the next year. We only earned 40 of that revenue in the prior year. So those are a little bit confusing. They will come at you, but don't worry, it will be fine. All it does is take a little practice, so doing the homework will actually help out on all that. So, Chapter 7, let's work on the practice. So, problem 1 brings in Spooky Corp. Ooh. So, Spooky Corp, I just like saying spooky. Spooky. Okay? Uses the allowance method to account for uncollectible receivables. The unadjusted trial balance as of December 31st, 2015 for Spooky Corp indicates the balance of accounts receivable is $450,000 and the allowance for doubtful accounts has a credit balance of $180,000. Okay, so there's some big things right there to watch out. One, we know accounts receivable has this amount, and allowance for doubtful accounts has a current credit balance of $180,000. Okay, so we're using the allowance method by basically knowing that we already have allowance for doubtful accounts, but it also states that we're using that. On December 31st of 2015, the accounts receivable aging schedule, so if we're dealing with the aging schedule, it means we're probably dealing with an adjustment entry, is completed and is estimated that the new credit balance for allowance for doubtful accounts should be adjusted to $17,120. Okay, so with this, we need to make our journal entry. So again, we're going to have our date. Our date's going to be December 31st. And again, we're setting it up. So bad debt expense gets to be $16,940. Allowance for doubtful accounts is also $16,940. Now, you're going, wait a minute. I thought it was going to be $17,120. Now, again, watch out for this. Our allowance for doubtful accounts already had $180 also as a credit. We want to make sure our ending balance, because we did an analysis and we're dealing with receivables, should be $17,120. So we're going to take the $17,120 and subtract the $180. Okay, this gives us the $16,940. Okay, so again, this one's an adjustment. Now, assume that Spooky Corp decides to use the direct write-off method instead. Record the doubtful allowance estimate in the journal. We just figured out that direct write-off does not have an estimate. So if you have something like this that tells you to record it, well, there's going to be no entry because it doesn't have one of those accounts under the direct write-off method. Only under allowance method. Okay, So watch out for that. Now, let's go with problem number 2. Okay? So problem number 2 that we have here, we have Creepy Ink. Ooh, is a costume supplier. Seems about right. A lot of costumes gone creepy nowadays. And on December 1st, 2015, Creepy Ink sold 100 costumes in exchange for $2,000 on a 12% 90-day note. Oh hey, so we're doing a note. Yes, awesome. The cost of the costumes is $1,000. Okay, so the first thing that we have to do is record the sale of the costumes. So guess what? This is probably going to bring you back to buyer and seller in chapter 4. So when we're selling these stuff, remember there's 2 accounts involved when we sell. So let's go look at what they are. Again, we're going to have one this time around. It's Notes Receivable. Okay, it's not accounts receivable. It's Notes Receivable. Again, this is a note that happened. So watch out what it's basically giving you the story. So in chapter 4 we did with accounts receivable. Here we deal with notes receivable. And now we deal with our sale. So $2,000. Now we record the cost. So it cost us $1,000 to get those costumes to sell them later. So our cost of merchandise sold, again, could be cost of goods sold, however you want to go, same thing, was $1,000. We got to recognize the expense. Well, we have merchandise inventory that we no longer own. We have to record that as a credit. So watch out again with sales. Usually it's going to have 2 if it's a merchandiser. Okay. So next we journalize the adjusting entry to record the accrued interest on December 31st. Again, this was a 90-day note. And we did it on December 1st. So we only have 1 month. So only 30 days that we're going to use to figure this out. So again, interest receivable, because we're expecting to receive this interest, the payment on interest of $20, basically the $2,000 times 12% times 30 divided by 360. And again, we've earned the interest even though we haven't received the cash for it. So we have to basically credit $20 to interest revenue. Okay. So on March 1st, they actually decided to pay us. It should have been about 90 days. So again, this is the method that you should go with. First off, put the date on. Date's March 1st. We're going to first put on note receivable of $2,000. Again, note receivable is always the principal. Should never change the amount here. Because they no longer owe us because they paid it for it, we put $2,000 in. Okay, it's credit now. Same thing with interest receivable. We should have now got the $20 back for interest. So those 2 we know right off. Now, interest revenue, it's going to be the remaining interest that we should receive. Now, figuring $20, that's 1 month that we figured up here. We have 2 months left. Times that by 2, should be $40 in interest revenue. Again, you can do this one right here. I could have taken 2,000 times by 0.12 and then times it by 60 days that we had left, 360, and that should be fine and dandy. No problem there. Okay. Now, when we actually count these due dates, the due dates are going to be exactly 90 days. When we calculate interest, they get to be a little bit when it's like the 31st of a month and so forth. So don't always expect that's exactly starts on December 1st. We count all the way to March 1st. There is going to be a little day link. Okay? And remember, we got month of February too. So month of February throws all kind of loops. So we have probably 28 or 29. So you got to watch out on that too. But if the book gives you a due date, go with that due date. So once we have all these calculated, we know what we received. They paid us, so it has to be cash. And we're just going to add all those up. And that's going to be our debit. Okay? So again, I do provide the little formula because you can figure out that way also. But sometimes it's easier just to knock out all the credits. But if you want to do cash and you just want to do the formula, take 2,000 times 0.12 times 90 divided by 360. Once you do that, make sure you add the principal. Okay, so add 2,000. Okay, don't forget to add the principal back, because if you don't, you're going to have 60 bucks, and you're definitely not going to balance out. Okay, that's why I like it doing this way first, and then just add them up, and that be your cash. Okay, either way, perfectly fine. So that's it for chapter 7. So if you have any questions, please put in the comments below, or you are more than welcome to go ahead and email me, however it goes, because this episode of Accounting 2301 is officially wrapped up, and hopefully y'all had learned something. But please, I will always appreciate feedback. Make sure you give me some. Okay? Y'all have a good one.